Goodbye 2023. Hello 2024. Peter D'Angelo, branch manager for Guaranteed Rate. I thought, what better time to do a look back on the year, take a look at all those highs and lows, and take a look at maybe where things could be going next year and give you a kind of full comprehensive wrap up, update you on some things that are on the horizon for 2024, and then hopefully empower you with the knowledge to make the right decisions for your personal family, making investments in real estate, buying your first home, buying your next home, upsizing, downsizing, whatever it may be. The first thing to share, which I'm extremely excited about, is I'm going to make a more regular thing of this. On a weekly basis, I will be releasing podcasts on Mondays and Fridays where I will dive into the mortgage market, mortgage interest rates, mortgage guidelines, as well as real estate trends, real estate news. And then on Wednesdays, once in a while, I'm going to pepper in a little something extra that's a little bit more of my own personal interest. And maybe it has to do with real estate, maybe it has to do with mortgages, or maybe it has to do with neither. But just a little something that I think would be helpful and beneficial to anybody listening. This is going to be called Mortgages, Markets, and More. And it will be starting as the new year starts. So I will be releasing information on that so you can subscribe. But for now, everything will be living on YouTube until year end. And what we're going to do right now is go through a rather exhaustive review of the year from multiple different angles, as well as taking a look at 2024 and some information that may be beneficial to you if you are involved in real estate or at all interested in real estate for your own family or for investment purposes. First things first, there's been a lot of awesome things that have happened here at Guaranteed Rate. So let's take a look at some of the key highlight points looking back at 2023. First and foremost, we released our Rate app. It's an all-inclusive health and financial wellness app that is free for anyone to use, and it has a tremendous amount of resources. We were thrilled to have the honor of Dr. Deepak Chopra at our launch in Times Square when we launched the app in October. And since October, I've been receiving tremendous feedback. People have been thoroughly enjoying using the app. In addition to health and wellness and financial wellness tools, it also plugs into Guaranteed Rates applications. If you are interested in a home equity line of credit, personal loan, or a mortgage, you can navigate through there and connect with me through my unique app with Guaranteed Rate. And super exciting. It's just a tremendous tool for anyone and everyone to use. Guaranteed Rate Companies also became the number 2 retail lender in the country, which is awesome. We funded over $3 billion worth of loans through our same-day mortgage, which is a service that we provide to our clients that will get their loan in front of the decision maker for your loan approval immediately and drastically reduces our timeline for closing. So $3 billion worth of loan volume has gone that route, which is tremendous. And that number is only going to go up as time goes on. We launched the reverse mortgage home equity conversion mortgage platform for our customers that are interested and qualify for leveraging that type of financing. We launched another app called Power VP. That's something I'm really excited about and I use on a daily basis that empowers me to serve my clients to the best of my ability from anywhere. Could be reviewing a pre-approval or sending over a pre-approval letter or reviewing their application and giving some guidance, live updates on the interest rates. Really powerful tool that helps me to help you and help my clients. We launched 223 new loan products, programs, and features this year. We solidified our HELOC and personal loan products as a strong component of our value proposition. We once again have more loan officers in the Scotsman Guide rankings for top loan officers in the country, 11 years in a row for that. We have more women loan officers in the Scotsman Guide than any other lender. We were named Chicago Agent Magazine's Lender of the Year for the 7th consecutive year. Guaranteed Rate Insurance was named a top 100 insurance agency. The Guaranteed Rate Foundation has helped 25 individuals and families and $248,983 worth of assistance this year, and to 549 individual families, and 7.6 million worth of assistance since inception. So that's our foundation that is funded through contributions, through our own fundraising efforts. And as a guaranteed rate employee, I contribute every paycheck to that foundation so that we can do more to help those in our communities. First things first, before we get into a look back, there's very important information about what lending is going to look like in 2024 that we are aware of right now. And we're going to start off with the loan limits. These are the limits that are set aside essentially from Fannie Mae and Freddie Mac, as well as the Federal Housing Administration for FHA loans and the Veterans Affairs Agency that establishes the lending and loan limits for veterans. Starting off, the general loan limits are $766,550 for single family throughout the contiguous US, and Alaska and Hawaii are 1.1 million, $49,825. And I'm going to throw up the graph right there so you can see all of those loan limits. But as you can tell, with inflation that's been running hotter over the past couple of years, it's been appropriate with the hot real estate market to up these loan limits so that the affordability and access is there for more people. Next up are the high balance and the super conforming loans. Typically, when you fall within those loan limits that I previously had up, that's your conventional guideline loan. When you move up and your loan amount is over that threshold for your particular scenario, you're in what we call the super conforming or high balance category, depending on where that property is that you're purchasing. Not all of the counties in the country will accommodate the high balance. Some counties, it's strictly your conforming loan amount and then what we call jumbo. Those are those larger size loans. However, in North Jersey, the majority of the counties, which is where I'm from, majority of those counties are considered a high cost area, which allows you access to these high balance loan limits, which I'm throwing up right there. And taking a look at that, it's 1.149825 for single family residences. It goes all the way up to a four family property would be 2.2 million, $11,600 as a maximum loan size. There's a benefit here in the sense that jumbo interest rates sometimes can be a little bit more volatile and they could be more expensive than your conforming loan interest rates. That's why there's this distinction, and that's why it's beneficial that that high balance is there to catch. Those interest rates are typically on balance a little higher than your conforming, but not as high as, let's say, jumbo may be in certain scenarios. Next up is the FHA loan limits. Throwing that over here now. So you can see 498,257 is the single family limit. And then in high cost areas, it's 1.1 million, 49,825. High cost areas where I am in North Jersey, a lot of these markets can accommodate and are designated as high cost. So that means that's your maximum loan amount for an FHA loan. Lastly, but certainly not least, going to throw up the VA loan limits for 2024. And for a minimum FICO score of 580, the maximum LTV is 100% with your VA benefit. And you can get a loan up to 1.1 million, 49,825. And you can see the breakout there. Cash out, if you do a cash out refinance, leveraging a VA loan, that's what that looks like. And the IRRRL is the interest rate reduction mortgage. If you're just going to refinance for a lower rate, those are the limits listed off to the right there. Other than those loan limits, there's some cool and exciting product updates and different loan programs that are available in 2024 that is either new or recently added, or just a continuation of really great products that I wanted to make sure get highlighted to keep on your radar as you head into the new year. First and foremost, the most exciting of all of these was in November of 2023, Fannie Mae announced that you will be able to reduce your down payment when buying a primary residence that's a multifamily home to 5%. For comparison, that was up 15%. I've posted other videos on that in the past, but this is an extremely helpful tool now that opens up affordability and access to so many buyers, particularly first time home buyers, to the multifamily space. Whereas before you would have had to have put down a more considerable amount of money. This helps the access to those products and the affordability of those properties. The next step, which is very exciting, is the first time home buyer home ready loan program that's got some new juice because there's certain markets that if you currently live in a prescribed neighborhood designated by Fannie Mae and by this program, you can have access to, get a load of this, you can have access to a reduced interest rate, $5,000 grant from Fannie Mae to help defray your down payment and closing costs. Guaranteed rate kicks in a credit of 1%, maxing out at $3,000. Your appraisal charge gets refunded to you. And if you use the grant money and the guaranteed rate credit to permanently buy down your interest rate, the way that the rate sheets have been breaking out, I have seen that provide tremendous relief from a monthly payment standpoint, as well as an interest rate standpoint. So that's a really awesome product that we are offering here at Guaranteed Rate. Very excited because I know that it's going to help a tremendous amount of borrowers as we go into the new year. Other programs that I wanted to highlight that we've had all year long and we've added to that mix over the course of 2023, and there's very likely going to be more on the horizon, is our suite of investor products. So if you're an investor in real estate and you need access to loans that maybe don't necessarily drill down into your personal financial situation, but more so lending based upon cash flow of a property or strictly based on your profit and loss, we do have these loan products available, and they are extremely helpful in growing your portfolio in real estate, or if your qualification scenario falls outside of the normal guidelines, these are some great products that are available to you. And lastly, but certainly not least, we are continuing with our promotion and servicing the New Jersey state bond programs, which are inclusive of the police and fire retirement system mortgage loan. That has a tremendously reduced interest rate compared to margin for those that qualify, as well as other first-time homebuyer products that can also include grant money that can help with down payment and closing costs. So we'll continue doing that into 2023. Now, for the really fun and exciting part, the market recap. Let's do a full sweet look back at the real estate market to start. So, we're going to look at three main data points, and I'm going to throw up the first graph right now. This is the 2023 national home sales for housing inventory, existing home sales in general, and then the housing inventory for active listings throughout the United States. As we look at February of 2023, existing home sales housing inventory, so these are homes not sold yet, it was 970,000. Existing home sales were 4.55 million, and the housing inventory with active listings was 578,627. So that gives you a scope of where we were starting as we were exiting the holiday hangover and heading into the new year of 2023 at the time. Let's now compare that with the median. So the median of home sales, median sales price of existing homes going back to February was $361,200. The median sales price for existing single family homes was $365,400. And the Zillow Home Value Index for all homes, including single family residences, condos, and co ops in New Jersey specifically, is $464,189. So as we see there in this graph, that steps up a little bit. The median sales price is something we like to look at because it eliminates the outliers. So this is the most commonly occurring number. Median is not the average. It's the most commonly occurring number. And that's how we got our $365,400 for the single family home median price in January of this year. If you've been following along, you know that these numbers have all moved quite a bit throughout the year, and it's gone up and down. But getting over to our next graph here, median sales price of existing homes halfway through the year in June was 410,000. The median sales price of existing single family homes was 415,700, just a touch higher. And then the Zillow Home Value Index for New Jersey, inclusive of single family condos, co-ops, was $482,331. So it moved up slightly from January to mid-year. For context, we're going to look at the interest rate situation at that time, and that will give you a good indication of where things are at from a cost of financing perspective and what effect that had on the market. And lastly, we're going to just bring it up to October. That's where we have the most data at this point. More information will come out in November. That's all stuff that I'll report on as we go out into the new year and as the podcast gets rolling. So the median sales price of existing homes was $391,800. The median sales price of existing single-family homes was $396,100, remaining consistent margin between the two of those. And then again, in New Jersey, the Zillow Home Value Index was $495,846. So ending the year still up. Obviously, not at the high rate, but median sales did go up 8.5% from January to October of this year, showing that the housing market's still resilient. And the reason for that is a lack of inventory at its core. A lot of people have those low mortgage rates. They're not interested, particularly in moving, even if they need more space. That 3% interest rate or 4%, or even for some, maybe 2. That's a really tough pill to swallow when you're looking down at one point in 2023, an 8.25% interest rate in some scenarios. So inventory staying low. Demand has not wavered at all. It's just how active that demand is. There's still a ton of buyers on the sidelines that aren't involved in actively shopping for homes, whether that's through discouragement or being priced out of the market entirely. There are going to be more people that come back into the market in 2024, in my opinion. And we'll see hopefully a little bit more healthy inventory numbers start showing. But time will only tell on that, and I believe that it will come down to how much of a discount we wind up getting on our interest rates as we head into the new year. Speaking of interest rates, let's talk about that for 2023. It was pretty brutal. I'm throwing up over here a very quick snapshot. The 30-year mortgage rate was 6.27 on average in the country in January. In November, it went up to 7.4. And now that we're in December, we're at around 7.2, probably a little bit less than that at this point in time with some of the market movement that's occurred. So we've cooled off about 1% or so, or a 0.5% rather, from November to December. But if we're looking at the overall increase in the interest rate, 1% is not terrible when we were looking down, like I mentioned, close to 2% at one point when rates peaked this year. FFR is the Fed fund rate. That's the discount rate. That is the rate that the Federal Reserve sets for lending. That was at 4.33 in January. November, we peaked at 5.33. And as of recording this, Federal Chairman Jerome Powell has indicated that they made their decision to not increase interest rates. And now there's conversations about rate cuts and the forecasting for those rates. I will be doing a separate deep dive video into that and into the monetary policy, inflation, all those things, and hopefully can break down those concepts in a way that can be understandable and maybe help you make some decisions about your family planning too. 10-year Treasury is also indicated here because the 30-year mortgage rate is very closely tied to the 10-year Treasury. It's the most comparable investment vehicle next to the actual mortgage-backed securities, which drive mortgage interest rates. So that was at 3.53 when we started in January. November is at 4.5 at the end of the month. And as of recording this, we're just about at 4%. So in the beginning of December, we were at 4.2, but now we're at about 4%. breaking down this information, this is showing us that we're going to see some interest rate relief. We've experienced it. This 10-year treasury topped out at around 5%. It was actually a few basis points higher than 5% at one point. And so this is welcome that it's cooled down, and we're starting to see some more affordable interest rates because of that. Now let's look at the graph. Let's look at it going back to January this year. What we're looking at is the 30-year fixed rate mortgage rate average in the US, the federal funds effective rate, and the market yield on the 10-year treasury on a consistent basis. We see that same snapshot here, 6.27 in January, Fed fund at 4.33, and the market yield on the 10-year constant maturity treasury, which is the 10-year bond, was at 3.53 in January. And we can tell from the graph that there's some valleys and some peaks. It does look like mortgages peaked out in October of this year. And it also looks like the yield on the 10-year treasury in tandem with the 30-year mortgage rate peaked in October of this year. The most recent data still at this point in time is November. So we're going to look at November to kind of get a snapshot. And as of the snapshot that you're looking at, the 30-year fixed rate mortgage is certainly less than that now. We're hovering around 7%. But for November, it was 7.44. Fed fund rate is at 5.33, which looks to be what we're going to have for the foreseeable future. And the 10-year constant maturity treasury at 4.5. That now is down to close to 4%. Overall, we had to stomach 1% increase over the whole year on the 30-year average mortgage interest rate. But it was a wild ride. There was a number of people that were priced out of the market for every 1% of interest that the interest rate goes up. 5 million would-be homeowners get priced out or priced back in, depending on the direction that the interest rate goes. So when we were at 8.25% on a 30-year mortgage rate, there were 5 million people who recently then were unable to purchase because the price was too high. They wouldn't qualify. Now that we've seen that come down to the level close to 7%, there's a good 7.5 million would-be home buyers that are back in the game again. If we see further improvement, that number can go up. So the opportunity can certainly be there. Looking ahead, this has been a wild market with low inventory, but it's going to continue to be a need-based market. What do I mean by that? The only people who are going to be listing their homes to sell are going to continue to be the people who have debt that they need to get out from under and they need to sell. People who have experienced death in their family and estates managing property. People who get divorced. These are going to be the top 3 reasons why someone lists their home for sale. Not to say people won't be listing their home to sell when they are ready to move somewhere, but as the rate environment gets better, we'll see that open up a little bit more. But my expectation is not to see the floodgates open with inventory. I also subscribe to a belief that during COVID, we saw a migration across the country, a great migration, we could even call it, where people had made their moves. While lending was cheap, they made their moves. They pivoted their job. They found a new place to live or a new place to take their family. Maybe they moved for a better opportunity with jobs and secured that new job. That all happened at such a high volume in that 2-year period in 2020 and 2021, and maybe a little spillover into 2022. But there was so much activity that happened in that time period. I would wager a guess that was probably close to 5 years worth of transactions that maybe got shoehorned into that 2-year period, which means it stands to reason that we will only see a slower real estate environment as we go forth for the next couple years after that great migration that occurred. Now, I have read some articles. It is becoming more popular for people to boomerang back, so that may be an element to consider, but these are exceptions to a rule more than the actual rule itself. As far as interest rates are concerned, I get asked where are they going, and it's a loaded question. There's so much that goes into that, but suffice it to say this. The market has their intention of where they think the economy is going. The Fed, who sets interest rates, has their job that they need to do to ensure stability in the economy. And then who is it that is at the end of all of this? It's us. It's the consumers. It's the would-be home buyers or refinancers or people looking to get any type of lending. So let's take a look at a couple of those aspects. And we're first going to start with the Fed because it's topical. I happen to be recording this on the day that the Fed announced that they're holding. So Jerome Powell was able to make his comments. I don't know what the market reaction is at this point, but currently the 10-year Treasury dropped very quickly, 20 basis points, which is 0.2%. That's going to have a trickle down effect to make financing less expensive in the short term. They also said, Jerome Powell also mentioned that they are seeing 3 rate cuts in the forecast for 2024, while they are still keeping on the table the possibility of hiking rates if inflation proves to be sticky. This whole rate game, all of this is so that the Fed can lower inflation stable while keeping the economy stabilized. You may have heard this term soft landing. Soft landing is referring to tightening of monetary policy so that inflation can come down, but not cause a recession, which typically happens when monetary policy gets tightened. For example, if we look back at 2008, the Fed was trying to tamp inflation. I have another video you can check out that goes in depth in this time period, but for our purposes right now, the Fed raised their rate, tried to cool inflation down. Then there was a recession. Now, albeit there were other things and other mechanics at play, but you can rewind to other times in US history where the Fed had to raise the rate of the Fed fund rate, and it caused recession nearly every time, save for one time. In the 90s, in the mid 90s, there was a brief recession, and the soft landing was engineered at that time. Jerome Powell has been trying to make that a reality as they've been trying to work together and bring inflation down. And this is the most optimistic that anybody's ever been since COVID and since this monetary policy tightening started, that we may be able to see an actual soft landing, which would mean that unemployment doesn't go higher. People will be able to remain in their jobs. Inflation will come down. The cost of goods will not grow at the crazy rate where it peaked in June of 2022 at, I think it was 9.4%. Now, the latest inflation reading has us running at close to 3.1 year over year headline CPI, Consumer Price Index, which is the Fed's preferred gauge of inflation. Now let's talk about the markets. As I mentioned before, the 10-year Treasury bond is the important one to pay attention to for mortgage rates. However, there's a number of different bonds that you can invest in. Without doing a crash course on bonds, suffice it to say, a bond is buying federal debt that has attached to it a value in the future, and you typically buy that debt now at a discounted cost. So, for example, a 10-year bond you buy today for $95, and they say 10 years from now, we will pay you, there's a face value on that bond, $100 for that bond. You've made $5 on that bond. That $5 is the yield on the money that you've invested in the bond. So, as we look at bond yields, that's what we're talking about. That $5 is the yield. So, when we're talking about 4% yield, that means if you buy a bond today, it will yield you 4% when it pays out at the end of its term, which we're looking at 10-year, but there's also shorter terms and longer terms. There's 30-year, all the way down to 2-month. So when we're looking at this, they are pricing in, based on their speculation and how these bonds are being traded, they're speculating on where they think the market's going to be from an interest rate standpoint. What's the economy going to look like? What's the value of the dollar? How is inflation looking? All of that gets considered by these bond traders that when they buy and sell, establish what that yield is going to be. Right now, that's all priced in for 130 30 basis points worth of cuts. That means the Fed fund rate right now is between 5.25 and 5.5%. So 100 basis points would be 4.25 to 4.5%. And they think it's going to go down even further than that. We heard it straight from the horse's mouth today that Fed Chair Jerome Powell said they are forecasting 3 hikes and roughly 100 basis points. I think they said 75 basis points worth of cutting over the course of the year next year, with no expectations at the present of cutting interest rates prior to June. The market says otherwise. This is important because the market is what's generating the interest rates, not the Fed's actual policy, not their actual rate. So we have ourselves an opportunity here, in my opinion, that you can get a lower cost of financing now than you may be able to get in 3 months from now, because it's happened before since the Fed has gone on this rate hiking campaign trying to bring down inflation. We've seen it happen before where the traders in the bond market did not believe the words that Fed Chair Jerome Powell was saying. And they thought, no, maybe there's going to be cuts coming. Interest rates will go down. And they placed those bets, for lack of a better term, and it yielded an economy and it yielded a market that had lower interest rates. And then when that didn't happen, we saw rates shoot up because of the adverse reaction that was in the market. The Fed won. So now we find ourselves in a comparable scenario. Will this create higher interest rates in the future? There's a possibility. And unfortunately, there's a possibility that this could happen in the spring market. So we still have a lot of data to get when it comes to getting a sense of where inflation is and where things seem to be trending. And I'm of the opinion that as we get the information from retail sales numbers and all of these elements that influence interest rates, it could possibly create an environment in January, February, where the Fed sees inflation tick up. And if the inflation ticks up, that indicates they're not done and they cannot provide relief yet. They also mentioned that they will not be cutting interest rates preemptively. The only time they're going to cut is when they see inflation reach a level, which is at the 2% target established by the Federal Reserve. When they see it close to that target, they will engineer a soft landing as long as progress is being made, or they will cut rates if they need to stabilize the economy in the event that unemployment shoots up, in the event that there's significant negative market reaction. So why am I going into such detail on this? I think it's important to understand how does all of this operate. And I'm not going to just tell you my opinion and leave it at that. I want you to be armed with the knowledge that I'm considering when I give my opinion. And I see a likelihood of that happening. Not a high likelihood, but it's very possible, which means that, as a brief call to action here, don't delay getting pre-approved and don't delay your home shopping thinking that, oh, well, inflation will cool, rates will go down. I can go on and on about how in a lower rate environment, we're going to see more buyers come out of the woodwork and we'll still have a supply demand issue with lack of inventory. And you may still not be able to get good value on property necessarily. And we could see values shoot up in a lower rate environment, which means you're going to pay more. And there's a delta there. There's a way that that makes sense, and there's a way that that doesn't make sense. So that's something just to consider if you have been toying around with the idea. Take a look now and take a look at some opportunities, because I believe that they are there. Market conditions for higher rates could happen with inconsistent information being provided. So the data points, we're talking about inflation here. If inflation rears its ugly head, rates could get higher again in 2024. Everyone's very optimistic right now that inflation is getting under control. Nobody's sounding the victory bell, but right now things are looking better than they have for the first half of the year, for sure, but even more optimistic as we look to the new year. If we see strong holiday retail sales, that could contribute to inflation, then inflation could tick up. It may just be a moment in time, and it may get weighted properly in that, all right, well, that was retail. What is it going to look like January and February of 2024? That'll give us a better indication. The other is that the Fed is pretty clear that they don't have any exact plan to cut by a prescribed time in 2024. But Jerome Powell did indicate very likely later in the year, and they need to see that the economy is remaining stable, healthy, and inflation is coming down continually at the proper pace. Market conditions for low rates are essentially weak retail sales numbers, inflation cooling even further as we just start next year. Pretty much in January, February, if inflation continues to trend downward and cool, we may see low rates actually closer to where the market is expecting to see low rates, as opposed to with the Fed, where they see it later on in the year. If the Fed cuts by March, we're going to see a tremendous impact on mortgage interest rates, and an impact that will help affordability in a big way. And the not fun one is recession. If we hit a recession by 2024, you can pretty much expect that rates will come down. We'll see a lower interest rate environment for mortgages. But any time that I talk about interest rates, I like to remind everyone that the world we lived in from 2008 until 2020 was a very, very different and manufactured market. And the reason I say this is the federal government was heavily involved in stabilizing the economy after 2008. And that happened for years, more than a decade and a half. So, as painful as these interest rates are, as high as they have gone, the average interest rate for a 30-year mortgage in this country still is 7.6%. So, we are getting below average interest rates right now with just some momentary relief. Bear that in mind. The days of the 3% and 4% should be behind us, because that is not indicative of a healthy economy. And if that were to happen again, there's, in my opinion, no way to anticipate that we're going to see interest rates drop like a stone and go down into that range again, barring some type of near economic apocalypse or apocalyptic scenario playing out where the federal government needs to step up and stabilize the economy. Here are the takeaways for those of you who are prospective home buyers, and particularly this one goes out to my first-time home buyers. If you've been shopping for a month or 2 years, it's been a difficult and painful series of events to unfold. And stick with it. You will have opportunity. I believe opportunity exists even now, but keep a positive frame of mind. And here are some things that can seriously help as you prepare for making that first purchase. Let your financial circumstances guide you first and foremost, meaning that take a look at your savings. Make sure that after a real estate transaction, you have money in your account for the rainy day fund or for the things that may pop up that you're not expecting. Home ownership carries with it responsibilities. Secondly, your income. Take a look at your income. And one of my favorite best practices is, if you are interested in buying and you have a budget, let's say you're renting now for $1,500 a month, and you know that your mortgage payment is about to be $3,000. You can do an exercise right now where you take the difference between that expected mortgage payment and your current rental amount and dump it in your savings account. Don't touch it. That money's not yours anymore. It will be for your mortgage in the future, but you'll get two benefits, major benefits. Benefit number one, you are getting used to that monthly payment. You're feeling what it feels like in your post-tax money that comes to your account after you've worked hard for that money, and you spend it on your rent and you put the money in savings. You get a good sense of what it's going to be like, and that may inform your decision when it comes to, oh, maybe I got to actually scale back. Maybe this is getting a little painful for my wallet. Second benefit, you're generating savings. You're putting money away for that transaction, which could help to defray your closing costs, could be additional down payment, and the give and take with interest rates going down. Sure, mortgage rates will go down, affordability goes up, but your savings rates will start to get affected too. So those savings accounts where you can get 4.5%, sometimes 5.5% interest on your money, that's going to go out the window when those rates do come down. And lastly is credit. This is the part that requires me or a mortgage professional go through the exercise of checking your annual credit report, which is available online through the government, and you are entitled to it once a year. It's the Free Credit Reporting Act that allows you to get that. Um, that will help you to see if there's any debt that you're not aware of or if there's possible fraud. But I think it's extremely helpful because it can help you to avoid pitfalls when you finally do get that offer accepted on that property that's perfect for you and your family. You would hate to lose out on that opportunity because it's something that was avoidable in the past. So be sure to keep an eye on your credit. And then, of course, going through the pre-approval process at Guaranteed Rate, we only use a soft inquiry on your credit, which protects your scores from them being negatively impacted. And it gives us all the information we know to give you the confidence that we've reviewed it, you are fully pre-approved, or hey, here's some stuff that would be beneficial for you to work on that can yield a lower interest rate, higher credit scores in the future. Now, if you're remotely interested in purchasing, you should get pre-approved now. Just do it. If you kicked around the idea with your spouse or your friends or your parents, it doesn't take anything other than a few minutes to complete an application. We get that. We take a look at your soft credit pull, which, like I mentioned, protects your scores. And then it's quick. I can get back. I get back to my clients very quickly. If you provide me with an application and some supporting documentation, within minutes, I'll be able to call you and give you a determination and maybe give you some feedback as to, well, if you're not going to purchase now within the next 10 to 12 months, let's set forth a game plan and a plan of action to best set you up for success. And that's really all of the benefits that pre-approval can provide to you. That's it for our full review of 2023. There's a lot of exciting things happening right now. And then as we head through the holidays into the new year, there's so much that's going to happen next year that I think for those of you who have been patiently waiting for the right time to get into the market to purchase, now is the time to get your ducks in a row. Now is the time to get pre-approved. Now is the time to really see what could be available for you and prepare for if and when those rates drop, or prepare for the opportunity that could pop up tomorrow in your neighborhood or in your desired neighborhood. Other than that, I wanted to wish everyone very, very well as we close out the year. The happiest of holidays to everybody. And I wish you all a happy, healthy, prosperous new year. Here's looking forward to much success and a much better real estate market for all involved in 2024. And looking forward to providing you with more useful information as I continue through 2024 and providing the top level service that I know everyone truly deserves for their home financing. Thank you so much for listening and take good care.